Welcome to the deep dive. We're all about cracking open those complex topics to get you the essentials. Today, we're looking at something interesting in accounting, trying to solve this puzzle. How do accountants give some financial comfort without doing a massive, full-blown audit? We're digging into what are called review engagements. It's this unique service, and it offers limited assurance. Sometimes you'll hear it called negative assurance. Think of it like this, maybe. An audit says, yeah, we checked thoroughly, looks correct. A review, though, it's more like, well, based on our checks, we didn't spot anything majorly wrong. You see that difference. It's subtle, but it's really crucial. It's a very specific kind of promise. And today we're going to unpack what that really means and how accountants actually get the knowledge they need for this kind of job. Okay, before we dive deeper, just a quick reminder, this deep dive is based on material from Farhat lectures. All the content, examples, and explanations we talk about here, they're derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe a CPA candidate, or already a professional, definitely visit the website. You'll find additional practice questions, video lectures, and detailed support to really reinforce what we covered today. Big thanks to Professor Farhat for providing this valuable material. Okay, so back to the puzzle. The first big step for an accountant doing a review is getting, well, enough knowledge about the client's business. Why is that so vital, especially if it's, not a full audit? And what does sufficient knowledge actually mean here? Is there like a risk of going too deep or maybe not deep enough?
Yeah, that's a great starting point. Because that foundational understanding, it's everything. To even think about giving limited assurance on financials, you absolutely have to understand what you're looking at. It's not just, number crunching. It really starts with getting a handle on the client's industry and their specific business operations. Without that context, the numbers are just, well, they're just numbers, right? They don't tell the full story.
Okay, so industry first.
Exactly. Industry first, you've got to be familiar with the specific accounting rules, the standards, reporting practices for that field. Like think retail versus construction, how they handle inventory or long-term projects. Totally different worlds. Imagine trying to review a builder's books if you don't understand things like percentage of completion or completed contract methods. It'd be, well, impossible.
Right, you'd be lost.
Completely. I actually heard this story. An accountant spent a Saturday morning in the office just poring over old work papers to get up to speed on those exact methods for a new construction client. And the key thing is the responsibility. It's on the accountant to get that knowledge, whether it's through like CPE courses. That's continuing professional education, super important.
Keeps you sharp.
Exactly. Or maybe hiring someone with that expertise or just hitting the books internally. It falls on them.
So it's not just a surface level thing. You really need to know the nitty-gritty of that industry. That's a big commitment. But then you also said understanding the client's specific business beyond the industry. How do you manage that without, getting totally bogged down, especially when the whole point is limited scope?
It's definitely a balancing act, you're right. But it's absolutely crucial, knowing the industry.
Yeah.
That's step one. But then you have to zoom right in on the individual client.
Yeah.
That means understanding their structure. Are they a sole trader, a partnership, a corporation? You need to get how they actually operate.
Like how they make money and spend money.
Precisely. How do they generate revenue? What are their main expenses? And what are the key things on their balance sheet? Assets, liabilities, what are the major moving parts? Take a software company. Let's call them XYZ Tech Solutions.
Okay.
A CPA reviewing them needs to know, does their revenue come from selling licenses? Or is it subscriptions, maybe consulting services? And if XYZ Tech has, say, multi-year contracts, how does something like ASC 606, the big revenue recognition standard, how does that apply?
That one can be complicated.
It really can,
Yeah.
especially with long-term deals. It changes when you book the revenue. So understanding their specific business model is just non-negotiable for applying the accounting correctly. It's really about knowing the mechanics of that specific company's financial engine.
That makes a lot of sense. It clarifies why just knowing the industry isn't quite enough. Okay, so we've talked about what an accountant has to know. But what's maybe even more interesting, perhaps surprising, is what a review doesn't require, especially when you compare it side by side with a full audit. This is where that limited assurance idea really clicks into place, I think.
Absolutely. And this is fundamental for anyone, looking at a review report. First big thing, in a review, the accountant does not check internal controls. They don't evaluate them. They don't test if they're working effectively.
Wow. Okay, so think about what that means for, say, a business owner reading the report.
Right. Internal controls are the company's own systems to stop errors and fraud. In a review, The accountant's focus is just on asking questions, inquiries, and looking at trends, analytical procedures. They're not directly testing if those safeguards are actually working. You're kind of implicitly trusting management systems more than in an audit.
Okay, what else is missing compared to an audit?
Second, there's no substantive testing, meaning the accountant isn't like digging into individual invoices or calling up banks or customers to confirm balances. They're not physically going out to inspect assets.
So less verification of the details.
Much less. It relies way more on what management tells them and analyzing the financial data patterns. It's not about verifying every single transaction like you might in an audit.
Got it. That's a big difference.
Huge. And third, and this is where limited really, really matters, there's no formal requirement to assess fraud risk.
Wait, really? No specific procedures to look for fraud?
Not in the same way as an audit. An audit requires designing procedures specifically aimed at finding material misstatements caused by fraud. A review, it basically operates on good faith, unless something really obvious like a red flag just pops up.
So for someone relying on the report, like an investor.
For you, the investor or the owner, it means understanding this trade-off. You get a quicker, probably cheaper report, but you're taking management's word on fraud, more or less, unless something looks clearly wrong. Now, however, if fraud or maybe some illegal act does become apparent during the review, maybe they just stumble across it, then yes, the accountant absolutely has to think about how it affects the financials and talk to management.
Okay, that's a crucial caveat.
Definitely. And one more thing. Unlike an audit, where contacting the previous accountant is mandatory if there was one.
You have to talk to the old auditors, right?
Right. For a review, it's optional. An accountant might call the predecessor to ask about old issues, but they don't have to.
So if you're the new client, the current accountant might not get that formal handover of potential past problems.
Potentially, yes.
Yeah.
It's another aspect of that limited scope.
So it's clear it's a much more streamlined process in those specific areas. Saves time, saves costs for the client, I imagine.
Generally, yes.
But there's definitely a trade-off in assurance.
Okay, so given all these things they don't do, how do they actually design the procedures they do perform? It can't just be a standard checklist, right? Especially with all that industry and client-specific knowledge we talked about.
Absolutely not. It's definitely not one size fits all. The procedures they use in a review, which again are mainly asking questions, inquiries, and looking at financial relationships, analytical procedures. We'll definitely dig into those more later.
Okay.
Those have to be tailored very specifically. They're based directly on what the accountant understands about both the industry and that particular client. So if our example company, XYZ Tech, suddenly bought, say, a manufacturing plant.
Oh, big change.
Huge change. Those review procedures, they'd need a total overhaul, new revenue streams, different costs, inventory maybe. Everything changes. And this leads to a really critical point. The accountant's always got to be assessing the risk that they might issue a report on financials that are actually materially misstated.
So even within the limited scope, there's still risk assessment. Oh, absolutely. If the financials look weird or inconsistent after they do their initial inquiries and analysis, maybe XYZ Tech's gross profit margin suddenly tanks for no obvious reason. Well, the accountant can't just shrug. They need to ask more questions, do more analysis until they're satisfied before they can issue that review report.
And that feels like it connects directly to materiality, right? That concept is everywhere in accounting. How does materiality play into a review? What does it mean for, us looking at these reviewed financials?
Materiality is fundamental. It's not just an accounting buzzword. It really dictates what matters. The core question is, could an error or something left out actually change the decision of someone using these financials? Like an investor thinking about buying stock in XYZ Tech, or a bank deciding on a loan.
So it's about impact, not just the dollar amount necessarily.
Exactly. It's all about the impact. What might be totally insignificant for a giant corporation could be a deal breaker for a small business. And materiality. It's always a judgment call by the accountant. They figure it out for the financial statements overall, as a whole. Then they use that judgment when they're designing their inquiries and analysis and when they're looking at the results.
Can you give a quick example?
Sure. Let's say there's a $5,000 error. For a tiny startup with maybe $50,000 in sales, that's 10% of their revenue. That's almost certainly material.
Okay, yeah. Huge impact.
But for a bigger company, maybe one with $1 billion in sales, that same $5,000 error, probably not material. It likely wouldn't sway a user's decision. So going back to XYZ Tech's falling gross margin, if the analysis points to something weird, The accountant uses materiality to decide how much further they need to dig. Is this just how the business changed, or is it potentially a misstatement big enough to matter?
That really clarifies how materiality was in practice here.
Okay, this is bringing us back nicely to the core idea, that limited assurance. So all this careful knowledge gathering, these tailored procedures, the materiality judgment, it all boils down to a very precise statement in the final review report, doesn't it?
Yeah.
How do they actually phrase that negative assurance?
This phrasing is absolutely key for anyone reading the report. It's the takeaway. The accountant doesn't say, yep, looks perfect. No. Instead, they give this very specific, very carefully worded statement. It goes something like this. Based on our review, we are not aware of any material modifications that should be made to the accompanying financial statements.
We are not aware of. That's the key bit.
That's the absolute heart of it. That phrase, not aware of, is negative assurance. It's their way of saying, look, we asked questions, we looked at the relationships, and nothing jumped out at us as being materially wrong. It's not saying, we checked everything and it's definitely right.
Right.
Yeah.
Subtle but huge difference. Exactly. And that phrasing is completely different from, say, a disclaimer of opinion, where they give no assurance at all, or an unmodified opinion, which is your clean audit report, or even something like a negative confirmation, which is a specific audit step, totally unrelated. Understanding that precise phrasing and what it implies, that's crucial if you're relying on reviewed financials.
Wow. Okay. What a deep dive indeed. You can really see the unique space a review engagement occupies now. It's this balance, isn't it? Getting a deep understanding of the business, but then using very specific, focused procedures quite different from an audit. And it all leads to that very distinct negative assurance. It feels less about like hunting down every last error and more about applying professional judgment to make sure there aren't any really obvious big problems.
Precisely. That sums it up well. What we covered today, it's really the foundation, right? How the accountant gets enough knowledge to even do the review. And that knowledge directly drives how they use their main tools, those inquiries and analytical procedures we mentioned. Those are definitely next on our roadmap to explore for review engagements. It's all part of a structured way, give a very specific and useful level of comfort.
So, wrapping this up, what does this all mean for you listening? Maybe think about the different levels of assurance out there. When would you want a review instead of a full audit, or vice versa? Why might that limited assurance actually be exactly what's needed for your particular situation or for a business you're looking at? Perhaps it really comes down to balancing the cost, the speed, and, well, the exact level of confidence you truly need. Something to think about.